Hello, I'm Andy Sanford, Transaction Services Partner from Blick Rothenberg Chartered Accountants. I'm delighted to be joined today by Rob Goodley, Tax Partner at Blick Rothenberg, and Mitchell Livingston and Freddy Collins from Quilter Cheviot Wealth Management. And today we're going to be talking about selling a business and wealth management. Rob, first question to you. When you're looking at selling a business, is it right to look at the wealth management at the end or during the process?
So definitely during the process, as early as possible, really. If you leave it until after you've, say, sold your business, then basically kind of the universe of things you can do from a tax perspective gets much smaller. So there might be some things you wish you'd done which you now can't if you haven't looked at it beforehand. The classic example is kind of wealth succession to next generation. So there's a very valuable inheritance tax relief called business relief, which mostly gives 100% relief for shares held in a trading business. That relief does not apply to cash. So the minute the deal's done, you've turned a very good asset for inheritance tax purposes into a very bad one. So, if you'd taken some advice beforehand, you might have taken some steps to effectively secure that relief ahead of the sale. I guess thinking a bit more broadly, because some of our entrepreneurs are frighteningly young, and inheritance tax might not be much of a concern for them, but once you have sold your business, you have to think about how you might structure your investments. You might use a company or a trust or something like that. If you get that all in place in advance, you can go from day one with the right structure. Otherwise, you can kind of have this dead period where you're not investing because you haven't got the right structure in place, and that takes time.
Okay, and Mitchell, what's your thoughts?
Yeah, I think there's a common misconception that wealth management's only needed after someone sold their business, but in reality, it's much more than just managing investments after a liquidation event. So, as Rob highlighted, there's some very clever things that we can do from an inheritance tax perspective before someone sold their business, where those opportunities are actually lost after they've sold the business. And then I think people forget sometimes about the fundamentals that we can look after. So, whether that's looking at protection for key employees or directors, whether it's looking at pension planning or things like cash flow modelling, which I'm hoping we'll touch on in a bit.
And Freddy?
Yeah, we will often find that companies will have a portfolio of investments that are effectively non-operating assets within that company. If they went through a bit of business simplification before they came to that business sale, potentially selling that portfolio down to cash and then starting to think about, potentially matching off liabilities, that will start smoothing that transaction as they come up to the business sale.
Excellent. And then I suppose the next thing to think about is what are the good things to make a successful exit?
Yeah, so from the investment management side, we will often find that an entrepreneur will be someone with a very, very high risk, profile at that time. They will then start making considerations for the rest of their life. So they've gone from this accumulation phase and then actually into a wealth maintenance. So their risk profile might have dramatically changed at the point of business exit.
Yeah.
I think from our perspective, the simplest thing that someone selling their business can do before they sell it is to look at cash flow modelling. Now, cash flow modelling allows us to forecast future finances, but the key for our clients is it helps them answer questions like, how much can I sell my business for and what can I do with the proceeds? How much can I afford to gift away without giving away too much that's going to affect my lifestyle? Am I going to be left with an inheritance tax liability and what's going to be left over to loved ones? And also how we can most tax efficiently take an income once they've sold their business.
I think, building on that, I can't name the number of times entrepreneurs said to me, I get the inheritance tax point, I want to give some value away. How much should I give? That's not a question I can answer, which is why you need to speak to people who can help you answer that in a scientific way, effectively. I think, if you look at simple things from a tax perspective, kind of building on Freddy's point, very common in these entrepreneurial businesses to have some non-core assets in there. There might be an investment portfolio, a property, or maybe a sideline business. The buyer's not going to want that, so tidy it up beforehand. And we can generally tidy it up with very little pain and very little tax cost, if any, if we do it in advance. Doing it as part of a transaction is really difficult. I'd say the other simple thing we come across regularly is, as many people know, is a valuable kind of tax relief for entrepreneurs when they sell their business. Tax rate of 10% on up to $1 million of proceeds. Obviously a fantastic relief, but the $1 million is often much lower than the proceeds that the individual is going to receive. Actually, many times it's a family affair, the business, so you might have a spouse there, the children, maybe wider family members. Actually, if you plan in advance to kind of share the ownership, you can multiply that £1 million limit to 2, 3, 4, 5, even more million. And it's £100,000 tax saving off the bat per person you can get in. And all that requires is some very simple legal work and a bit of planning in advance. often missed, sadly, and it's just value that's left on the table. I'd say the other very simple thing is when you have entrepreneurs who are kind of funding their lifestyle from dividends is stop taking them in the lead up to a sale, because you can most likely get that value out as capital and pay a much lower tax rate.
And we've talked about the successful points, but what are the pitfalls that you've seen, Mitchell?
So most of the things that we see go wrong are down to clients not having all their professional advisors singing off the same hymn sheet. So whether that's lawyers, other professional advisors, or the three of us who are sitting here. But to answer the question, the first thing that we see go really wrong is excess gifting. So clients are trying to gift money away to mitigate their inheritance tax liability. But what they often do is they sometimes give away too much money, which then can affect their lifestyle going forward. The second thing is they don't realize the actual impact that selling the business has on their inheritance tax position. So as Rob was mentioning earlier, when you own the business, a lot of the time you qualify for business relief. Once you sell your business, that qualification goes away and all of those assets are subject to your estate from an inheritance tax perspective.
Yeah, I'd say it's not all entirely lost right in that moment. You know, we do have a time frame, which is effectively 3 years where a rollover relief still applies. You know, there are specific listed assets, you know, that you could put in an investment portfolio that would still enable you to qualify for that business relief. So we would, for instance, have a specialist team that would then run something which we would call our AIM service. That's the alternative investment market. And that's still available to these entrepreneurs, even if they have left themselves exposed.
And that goes back to singing off the same hymn sheet, and that's why we all need to be on the same page.
And that is very valuable, but like I said, I guess as I said earlier, it's a reduction of your universe of options, isn't it? If you'd done it beforehand, you wouldn't have to kind of take that mitigating step into kind of specific investments. I would say for me, I generally try to say to my entrepreneurial clients, if you were selling your house, you'd make sure it was tidy before you did so, right? But so many people don't think that way when they sell their business. So what is the tax, what is the legal, what is the financial and commercial risks in your business, and what have you done about it? So if I look kind of from a tax perspective, I'd say the one that comes up a lot, sadly, is, you know, an entrepreneur is recognised, they've got a new tier of management coming through, I need them brought into the business so a buyer sees there's somebody to take over from me. I'll give them an ownership interest and they'll share in this deal, and they put it in place on the cheap and it doesn't work from a tax perspective as expected. That comes up late in the day and it causes all kinds of problems, as you might expect. I mean, Andy, you and I have seen, you know, looking in outside of the realm of tax, many other problems, right? So clients don't have their financials in order and that comes through on the deal. Never a great place to be.
Yeah, definitely the financials. And actually the other key point is actually informing key staff of the transaction. Often the entrepreneur can keep it far too close, not involve the key personnel, and then when the company who's acquiring comes in, they don't know what's happening, or they haven't been trained properly, and they give no confidence to the potential buyer.
Yeah.
And so that can be a real problem. I mean, the final thing I just want to cover on briefly is we act for a number of serial entrepreneurs. They'll often have some investing activity, often be selling their businesses, and have some existing trading activities. What's your thought in the overall wealth management space there?
Yeah, it's actually a very key business area for us. You know, the same people that set up businesses tend to be the people that keep on setting up the next businesses too. What we find is what they will do throughout their career is consider the businesses that they are running to be incredibly low risk, whereas actually some of these businesses are very, very high risk, and we try and make them take that one step back and say, actually, your separate investment portfolio that you might have on the side, that's really to protect you. In the cases that your company starts failing, it also tends to be at the same time as, let's say you had an investment portfolio full of, you know, blue chip companies, you know, in that economic downturn is where both things start to fail at the same time. So really, that investment portfolio that you have should be your fail-safe, not your accumulation of wealth for the rest of your life.
I think it's difficult to follow on from that, but Freddy and I know that the wealth management side of things is a job in itself. So for a lot of these serial entrepreneurs, time is their most valuable commodity. So our job is to take that pressure off them so that they can focus on doing what they do best, which is running the business, and leaving the wealth management stuff to the experts.
And Rob?
I think two things on the tax side. So succession, you know, you've got a core business asset which qualifies for these reliefs. Think about who owns that and in what format they own it. So you're starting to build that succession process. The second thing I would say is, you know, the entrepreneurial bone tends to run deep. So you'll see these entrepreneurs will have kind of maybe if you like a side hustle of investing in early stage businesses, because they can not only, you know, help financially, they can help with expertise. There are some really attractive specific reliefs that apply there, like a seed investment scheme. And because you've still got your business, you're probably still taking quite a good income and you're making gains from your side portfolio. So those reliefs can be super valuable. So it's about taking the right advice to make sure you get those reliefs, and you can then help those businesses to grow while saving a lot of tax.
Yeah, absolutely. And the other thing I would just add, in terms of particularly where you're handing on to the next generation, the entrepreneur needs to think about the ability of the next generation to run that business.
Yes.
And some early steps can actually help there, in terms of, rather than leaving it to the last minute when an actual event happens. Well, I've really enjoyed our conversation today on selling a business. If you need any further information on the selling a business through Blick Rothenberg, please do not hesitate to contact either Rob or myself, or your relevant Blick Rothenberg contact partner, or through the website.